Welcome back, listeners. My name is Larry Colvig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you're listening to the Haven Financial Group radio show, where every week we discuss crucial retirement and financial topics that can make the difference between surviving retirement and thriving through those golden years. Kim, we got Lance Larson, our in-house CPA at Haven Financial Group, on for the rest of the show here because we're going to have conversations on taxes. And we know that's a relevant piece to the retirement puzzle and probably will affect retirees more than any time in their past, which I know is not uplifting. But let's talk about maybe some of the things that we can do to avoid Uncle Sam getting the biggest part of our pocketbook.
Yes, absolutely. Lance, great to have you like always. Really appreciate it. And we giggle because we say taxes and your name in the same sentence. Please don't take that as an offense. That no one means that.
Believe me, he doesn't, Kim. He doesn't. He thrives on
it. He's a guy you wanted a dinner party, that's for sure. All right, let's talk a little bit first off about taxes in 2025. Have there been a few changes that retirees really need to be aware of? And Lance, we're doing this with the backdrop of the idea that we're going into the second half of the year, July 1. This is a new fiscal year for a lot of people. So we thought we would just update folks.
Yeah. So for 2025 right now, it's kind of the same thing we've been having for the last few years under the Tax Cuts and Jobs Act. There is, as everyone knows, there is the tax laws that are going through for the big, beautiful bill that they are working on. The House has passed a version of it. The Senate has worked on a version of it. But both versions are not the same. And so now there has to be some sort of reconciliation between those two. And unfortunately, at this time, we don't know what's going to shake out of that. So for right now, the best advice is to just plan on what we know and take action with what we do know. And then we can also keep an eye towards the future, saying, hey, this is what's possibly going to happen. The best thing that happens for us is that the tax rates stay as low as they are right now. The standard deduction stays pretty high. Worst case scenario, we go back to the old ways of doing things. So the tax rates go up and standard deduction goes down. And because of that, we want to make sure we have the proper plans in place.
Sure. So that shift in tax brackets could happen next year. In fact, it's scheduled to happen next year unless something is done. Correct.
So as it stands right now, today, that our 10, 12, 22, 24% tax brackets will be going up to 10, 15, 25, and 28. Mm-hmm. And that's what the new tax law is going to try to address. And we'll see if they can keep those tax rates down for us. But in the meantime, this is the last year of the Tax Cuts and Jobs Act. So this is the year that we're going to be taking a look and saying, hey, this is when we can do our Roth conversions and pay them at these lower tax rates. This is when people are trying to double up on charitable contributions. So one of the strategies that people are talking about for this year is that if you're a charitable person and you want to give to church or other charities, maybe we hold off on that in 2025 and wait until 2026 when it's potentially going to be a little bit better off for us tax-wise to do things like that.
Sure, absolutely. So let's talk about the best advice that you give to people who are looking at retiring, in the next, let's say, 2 years. What's the number one advice you give them when it comes to taxes, Lance?
One is to kind of just go into it with eyes wide open, knowing what your income source is going to be and what the tax ramifications of those sources are going to be. So mostly in retirement, we always talk about a 401k and the IRAs. Well, these ones are all going to be 100% taxable. But when we pull that money in there, that also affects a number one income source for a lot of people, which is their Social Security. So do we want to take Social Security right now? Do we want to wait on that? Just understanding those tax implications. And so that's where you want to have that conversation and be able to understand what are going to be your income sources.
Mm-hmm. A lot of people think that they're going to pay a lot less tax when they get to retirement age. That's not necessarily true, is it?
Not necessarily. because when you get into the retirement years and you have to start taking those required minimum distributions, there's couples that have been saving and saving and saving, and now they hit 73 and they have to take their required minimum distributions, which is about 4%, give or take, in the first year. Then they look at it and say, "Oh my goodness, I'm getting more income I'm getting more income right now than I did while I was working because of these required minimum distributions and Social Security payments and pensions." It becomes a good problem to have.
But a problem nonetheless. Is there a way around that, Lance? And is there some advice that you start to give people? How do you work around it?
So in the first part of the retirement years, for tax purposes, what we like to do is possibly delay Social Security so that we can take more out of the fully taxable IRA accounts. We start using that. If we don't need the actual money, we can start looking at Roth conversions to help reduce those required minimum distributions in the future. Other ideas would be, once you have to take those required minimum distributions, looking at possible qualified charitable contributions to church and to other organizations, and use that type of money so that it doesn't become taxable at that point.
Larry, did you want to add something?
Yeah, I do, because this tax discussion, these things that we're mentioning, they may seem foreign to some people, because the observation I've seen, especially since COVID, is there's a lack of tax planning that's going on with many folks. You get your taxes prepared. You may bring your box of statements to your tax preparer, drop off, pickup. I hear this all the time. We don't even talk to our tax preparer anymore. Well, as you get close to retirement, tax planning becomes that much more important. All those years you worked, you're putting it into the 401k and things, maybe taxes were fairly simple. Now you're looking at Social Security, you're looking at RMDs. We're big into forward-thinking tax planning, and people just aren't doing it because they're not getting that attention. We want to get together a couple times during the year. We want to map out a plan for retirees, distribution, income, how tax planning, what is the best accounts to draw from in the most tax-efficient way possible. And if you're just a drop-off pickup and not getting that attention, you're probably getting this when you get your taxes done. Oh my goodness, I didn't know I owed this much money. Every year I owe money, this. My solution would be, why not fix the problem rather than having the same problem every year? But if you're only getting together or not getting together and just dropping it off, you're never going to get that attention. And guess what? You're also going to miss opportunities like Roth conversions, IRA distributions, low tax brackets, zero capital gains tax, and a whole variety of other things, just because you're not in the know, because you don't have a partner to help you.
Sure. So let me ask you this. Here we come on July the 1st. Is it too late to start preparing for next year? And, because I know after December, it certainly is too late. Is it too late right now?
Absolutely not, Kim.
Okay.
This is actually probably one of the better times to kind of have a check-in with your income for this year, because at halfway through the year, you know where the first half has been. You have a reasonable idea then, what is the second half going to look like? And so this is a great time for the check-in, especially for those who happen to still be working and still going to be about 2, 3, 4 years away from retirement, that, hey, we can look at some things and get some planning going on right now, that this might be the time to do some of the Roth conversions, depending on what your income is. And we do that by looking at where your W-2 is sitting at right now. You'll have your pay stubs that say what you have year to date. And then from there, you can kind of project out where your income is going to be at and then make the appropriate plans.
Super. So this is the time, folks. You just heard Larry explaining it. A lot of people just drop it off, next February, and then they go to pick it up, their tax returns, and they're very unhappy. So if you're somebody who wants to get ahead of that, you just heard Lance say, this is the time to start preparing. So give the folks at Haven Financial Group a call. Not only can you talk to them about your tax issues, but you can talk to them about all of your retirement needs. That number is 612-504-8400. Let me give it to you again, 612-504-8400. Tell them that you heard the three of us on the radio and you'd like to set up an appointment, come in, talk to Lance, talk to Larry, talk to some of the specialists there at the Haven Financial Group. When we come back, Lance is going to stay with us. We're going to talk more about costly mistakes when it comes to taxes that retirees make as they head into retirement and then once they are in retirement. So be sure you stay with us, folks. This is the Haven Financial Group Radio Show.